but it returns now with full force. I'm Ilya Spivak in San Francisco. That's Dylan Radigan in Milan. Mr. Mike Butler in Chicago. Gentlemen, it's a second day of sell-off in stock markets. Woo-ha. How's your day going?
It's going great. It's going great. Yeah, the market's been really kind of in a narrow range the last couple of days. So I've been trading other things like lean hogs for one. But yeah, it's it feels like now we are waiting for PCE numbers because there's still plenty of.
Hold on. What is it about the? I mean, is there something about the lean hog that is particularly appealing as compared to the more,
the fattier hog?
Fattier hog?
Yes, actually. So, Mr. Westwater, we have him on the show every Tuesday on Options Trading Concepts Live, and he presents us with a futures trade idea or some kind of analysis of futures products. So, lean hogs, ultimately it's somewhat predictable from a seasonality perspective, and prices are sky high in /LE here. And into the rally on Tuesday, we were like, this feels like a good short setup because of the potential seasonality and the difference between the long and short positioning. So we ended up getting it basically perfect with a 2-day sell-off here, but went with a longer term diagonal spread, which is what we've talked about on the show here a couple times. But yeah, just getting out of the equity world where everything's just a vertical line straight up. I guess lean hogs is too, if you look at it from July till now.
Do they make markets in fatty hogs?
I don't know.
I think lean hogs are the futures market benchmark, and I don't think I'd be remiss to say there's probably not a sell Rosh Hashanah by Yom Kippur dynamic in this market.
One would think.
One would think.
But yeah. I mean, no one. Do you think there's a person out there that thinks this sell-off for 2 days means diddly squat?
I mean, I think if you look at at least the stock market here, you get the sense that, okay, it's a little bit lower, but it doesn't look like you've crossed any Rubicons here today. It doesn't look like you've broken down kind of the structural bounds of what's going on. I think if you were to look at, let's say, the S&P, and full disclosure, I nibbled a little bit on the short side here, just in SPY, not anywhere else. But the line in the sand for the S&P, let's say the December ES contract or so, seems to be something like 66.85, 66.90, something like that. And there's a kind of horizontal inflection thing there, and we seem to have landed right on it. It's even clearer in the NASDAQ, where if you just put a horizontal line at the mid-September swing high, the September 16th high, that tells you basically where the last swing before the last rip ran out and kind of had a little pullback. We landed right on it today and stopped. So it seems like we're looking at a situation where maybe there's not a story here about a sell-off. There's a story about the market pausing, and then we'll see.
Yeah, it feels like when you look at SPX implied volatility for the next couple of days, there's still 40 points projected for through Friday. And I would imagine that this number holds because tomorrow is a very low 26 points on either side. But we have PCE data and we have a higher implied volatility reading here, which tells me that maybe we see a similar day tomorrow unless something crazy happens. And then Friday is where we're projecting at least a little bit more movement with PCE coming out pre-market.
Mm-hmm.
It's interesting that the markets are getting all kinds of antsy, or at least looking at the implied vol. At least they're seeming to perceive something around the PCE number, because on one hand, the PCE number is relatively straightforward to forecast. Markets don't tend to get it wrong, because once the PPI and the CPI numbers are out, you can take the internals of those and kind of reconstruct a PCE index and know what it's going to be. So the forecasts are fairly good ahead of time. There's not really a major surprise risk. On the other hand, it has, nevertheless, despite all of that, slightly beaten relative to forecasts the past several times. And so you kind of wonder whether the event is the data or the event is the passing of the data, so that the markets can do what they want once they're on the other side of event risk.
Yeah, it's a fair point. I think the elevation in the VIX, I mean, it's not anything to write home about, but at least we're not setting new lows in the VIX for the near term. We've popped up a little bit, which projects exactly what you're saying. Maybe we're waiting and seeing, pricing in some volatility, and if we come out on the other side on Friday here, maybe it's a complete reversal in quite instantaneously. Because a 16 VIX, I'm still not, like, that means nothing to me. 16 VIX with a steep contango in the vol futures, when you look at the difference between the V, X, and Z contracts, how they're climbing higher in price significantly, tells me that it's up and to the right. Day to day, who knows, but up and to the right over a long period of time until something shifts here.
Yeah, I mean, what that something is kind of a curious thought exercise, because when I'm looking at these markets here, I mean, gold's a little bit lower, bonds are attempting to bottom, dollar's a little bit stronger. It's kind of a hodgepodge. There's not really a through line in a macro narrative where you can look and go, oh, well, they're concerned about blah, blah, or that, or this. Dylan, what do you make of this sell-off? Is there any rhyme or reason to any of this?
You know, I take it as, I mean, I take it as validation, very mildly, with very little conviction, but as validation of my sort of comments from last week, where so it was sort of a sell on the Fed meeting, if that's if that's a thing. And I think that's kind of I mean, that is obviously what's playing out here. Is it just sort of an exhaustion from all the things that have happened, meaning all the straight up action that's been going on? But I'm also, I mean, I have very little conviction, even though I know I was yammering on. I like my short gold and I like my long dollar. But short NASDAQ feels squirrely to me, at least in terms of my confidence in it at this point, or at any point, really. Just because of the momentum of those other names is so bananas that it kind of really hangs on, makes you pay attention, you know? I don't know how much this, I think this, you know, look at these charts, look at that chart. I mean, all these charts, it's ridiculous. And so I think that, you know, I'm almost more interested in, like, because you're always talking, Ilya, how you're waiting for an indication. Like, is this an indication to you that things are about to go south? The fact, like, like when you talk about sort of waiting for an indication, is this that?
It feels like it's interesting to nibble on the short side a little, because, and I did that this morning. I got a little bit short S&P through a SPY put vertical. Vol is still very cheap. You can still get excellent risk reward. I think I ended up with a little bit better than 2-to-1 on it. And I think it makes sense to nibble a little, but not to kind of get over your skis, because it is noteworthy that things are kind of getting a little chopped up here, and you're starting to get into undoing some of the internal kind of swing bottoms in the indexes, especially S&P. Russell was also fairly soft, although I haven't touched that one yet, because I think you get to a place when the rubber band is stretched this far, it's a shallow stair step up and a cordless elevator down if the thing really sells off, because it's going to start to really snowball on itself. There's tons and tons of exposure that there is to unwind. And so, do I have all the perfect confirmation here to say, oh, yeah, this is totally a top? No. But will I nibble a little bit on the short side? Yeah, just so I'm not left behind if this is, in fact, the real deal. But NASDAQ is going to wait. I think Russell is going to wait. They need to show, I think, a little bit more, especially NASDAQ, to get any kind of bared up there, because Lord knows we've had plenty of false starts this year.
Oh,
but
yeah.
I mean, the gold short is awfully appealing. And do you have an opinion on that?
I took my gold long off this morning. I had a nice run. I held it for almost 60 days, and I was coming up on DTE within, I think, less than 20 days. And so I thought, you know what, it's kind of soggy. I've got expiration coming up. Let me just take this off. This was a great run. And I was short puts in there and long that way. So I got to extract some premium as well. So it worked out great. I'm still on the long side of silver because I'm there more recently and via calls, and it didn't really break down today. So I'm sitting there. I'm very interested in the short side of gold. I haven't put it on yet. It seems like the line in the sand is maybe the September 17th high. So somewhere around like 3,700-ish. And if you can get a consistent close under that, okay, then yeah, I would be interested in getting short down into like 3,500, 3,450, something like that. But I want to see it.
Yeah, it's been just an absolute moonshot in a product that does not have that much implied volatility. Like when you weigh this move from, let's just call, the last 30 days, basically, we've gone from 3,350 to 3,750. It's a 400-point move in 30 days. Where is the next 400-point move projected in gold futures based on current implied volatility? The furthest out I can go, 153 days. So this has been an absolute blowout to the upside, and it has well exceeded implied volatility with realized volatility. So when that happens, I think, yeah, if you're going to be directional or take a stand, I think from a psychological standpoint, but also a hot odds standpoint, or, you know, could this reverse type thing, I do like it. I agree with it. I had a call broke wing butterfly in the upside in gold futures. That's going to be a bad loser, but I did throw on a new put diagonal spread to kind of reflect this idea. So I bought the 345 put in December, and I sold the 335 put against it. So you kind of have this risk one to make one, $500 max profit to the downside if we get a near-term move in GLD. But I liked using GLD here just because it's an easier way to get smaller in size and
I've been
have a
doing
position that grows teeth if it does move to the downside. So
I've been doing the same thing in both stocks and in gold and in silver. So using the ETFs to keep it a little bit smaller and to make sure the fills are there, because I mean, obviously if you go to the full futures contracts, GCSI, I mean, you'll get the fills, but those things are huge and you need the capital. So rather than go to MGC and put up huge amounts of margin to trade the futures outright, using verticals in GLD, in SLV, in SPY, in the Qs, that's been a little bit more attractive. it's an interesting setup here because it seems like stocks are down with gold today. Like if you look at the intraday charts, they look almost identically the same. And then the dollar is up as a kind of inverse, yet I don't think you really get a strong parallel lead from yields. And so you kind of wonder what this is and whether the market is just kind of jostling in the wake of the Fed or whether it's actually doing something.
Yeah. And that's what I think when we come back to this point in time, 3 months from now, 4 months from now, at the end of the year, if there is a big sell-off, I think we have to tie it at least to a degree to this. But what else is moving? Like that's what I'm missing. Like this to me, this flight to gold to such a degree, not paired with anything else. Like if we were to see Bitcoin at like 130K with gold moving this way, that's more of like okay, the money is moving away from anything tied to the US dollar and equities may see a sell-off. Like that's the positioning that I would see. But I'm just seeing the gold. Like we're getting a move today in Bitcoin, but all things considered, it's not a big move. Like gold is clearly the big mover over the past couple of weeks. But I'm trying to tie it to something and I'm having a hard time doing that. Because like you said, like everything else is kind of just fluttering around, at least right now.
Yeah. And the gold move really started before the move in the bonds and before the move in the dollar. So you look at it and you go, well, is this gold rally about a dovish Fed when everything was already priced in by the time it went? Probably not. It is, I think, interesting. So last week we got that summary of economic projections from the Fed. And I definitely did not have on my bingo card that they would cut rates and then upgrade growth expectations, upgrade inflation expectations, downgrade the unemployment rate forecast. Because they're cutting. So you'd think they'd go the other way. But it's almost as if they're saying, yeah, we're going to run the economy hot. And you go, okay, well, if you're going to run the economy hot, okay, I can see why gold would like that. But one would think, okay, well, then also Bitcoin, but Bitcoin hasn't rallied. You'd think also a dollar sell-off. No. And so you get a kind of disconnect. I'm almost more convinced in the stock sell-off because nothing makes any sense. Because it starts to feel like, well, what's like maximum rug pull for everybody? It won't be a news release. It won't be a narrative. It'll just be, okay, that's enough. Let's close some exposure. And then things that have been up come down and things that have been down come up.
Yeah. And for me, it's like these solidified probabilities of the rate cuts that we are to expect in October and December, at least the way the market is right now, 92% chance we get another 25 basis points cut in October.
Yeah.
And then a 75% chance we get yet another after that. And this is like as solid as I've seen it from a probability standpoint this far out in probably this whole year.
Yeah.
At least for the October one.
Yeah. And what's really interesting is that even a week before the Fed, you had markets saying, not quite this much certainty, obviously, but 70-odd% chance that October is a go, which is way better than even. 60-odd% chance that December is a go. So when the Fed comes out last week and they go, yeah, we got 3 cuts for you this year, of which September is 1, and then there's 2 more meetings, do the math. And you go, okay, well, but have they told the markets anything that the markets didn't know? I mean, to some extent, granularly, but the markets were well into this is the likely way forward. even a week ahead. And so, did they surprise anyone? Not really. And then they still only have one cut for next year, and the markets have closer to 60 basis points for next year. As of today, it's 63. So there's still this huge disconnect for next year. And either the market is right or the Fed is right. And if you looked at, I mean, as far as the data we got this week, the only one of substance was the PMI numbers out of the U.S., and they were down for a third consecutive month. So maybe the economy is cooling.
And where does that bring us, Dylan? If are we to just continue putting our bull hats on and just closing our eyes and letting the accounts flourish to the upside, or does anything spook you?
No, it really doesn't.
No.
I mean, I'm trying to get myself spooked because there's all these sorts of spooky things out there. But I don't see how you can really, I can see how you can, like, listen, as you guys heard, or you certainly heard, Amelia, last week after the Fed meeting, I was sort of hammering on this sort of short gold, short NASDAQ, long dollar, just on exhaustion and sort of resolution from the Fed meeting and the run up before the Fed meeting. But it's hard to hang on to that position with any conviction when you consider, everything that's gone on here. I mean, I suppose the one argument against the sort of Teflon or bulletproof nature of the rally in the market really goes to you could argue, well, the stock market because the dollar has been so face slammed this year, that on a currency adjusted basis, that the stock market's really only up a couple percent. And you could make an argument that if the dollar is actually going to get stronger, that is a reason to be bearish. But I mean, is there a real risk that this next round of economic data is going to meaningfully change expectations for timing or number of rate cuts, Ilya?
I don't think so. I mean, I think the really big question isn't even about this year at this point. I think the question is about next year and whether the markets and the Fed can kind of find common ground. But as far as this year, I mean, really, the Fed just gave their sign off on what the markets already had. So is there really anything else here that we don't know? Doesn't seem like it.
Yeah.
So that's why to your point, Michael, or to your question, I'm not like, I like my little short gold, long dollar routine on the margins, but at the end of the day, if there's a bigger sell-off, I'd buy that. You got to buy it. Who are we kidding?
Yeah, no, I agree. And every time we see a sell-off, as rare as it is these days, I think it's super important to just look at the VIX and more specifically the vol futures. So you can put this together. It takes like 5 minutes to make a watch list and just type in the codes for each month and then just sort it from nearest expiring to latest expiring. But just keeping an eye on this, because if there's two things that I've realized are essentially true with trading, it's that if you're going to be at all-time highs and set new all-time highs, the VIX is likely going to be in the teens, and you're going to see a contango like this where you have 2 points between the next contract or the current contract and the next one, and then another point after that. That tells you that the market doesn't have very much fear at all. When the opposite is true, like if we were to get a 100-point sell-off tomorrow and then another one on Friday, and you saw this flatten out where all of these numbers are in the 20s, and maybe the near-term ones are above the later ones. Like if this pops to 22 and this one jumps to 21, now we're in a different story. Now we actually have some near-term fear priced into the market, and that's what we always have seen when you zoom out and you look at the E-minis and these big sell-offs. Like in this period of time when we had the tariff stuff, we were in backwardation, and we had And that's what I'm referring to, where the near-term contracts are a higher price than the next one. Same thing with the Japanese yen unwind. That lasted like 30 seconds, but we still got that volatility reaction in the market. So I think if there's one thing to keep an eye on, and to your point, Dylan, like if we see a big move and it's not paired with a vol spike, or at least a vol spike that seems to matter, then I am more confident in buying that than if we see a big move or a couple days of a big move and there is a big change in volatility structure. That's where I might be more cautious.
And that's, and what's that even going to be, you know? Like, it's like, what's the hypothetical scenario that really kicks this market on its ass?
Well, I think maybe the most interesting thing as far as sort of market ass kicking is when it happens for no apparent reason. I mean,
Exactly.
I think that's really where I actually start to get the most bearish. Because if it happens for no reason, if there's not anything where you can very clearly go, oh, we'll just resolve this and then everything is fine. If there isn't a thing to resolve, it's just, you know what? Risk appetite is exhausted. And we need to reset valuations because things have gotten out of whack. I mean, I remember to this day, my best year in the markets was '08. And everything broke down in July. Did anything happen in July? Not particularly. It's just you reached critical mass. There was just no more buyers. And the whole thing just caved.
Yeah, it feels like, it's been a crazy run up from the bottom in April. But Nick was texting his friend. He was told his friend to consider something to look at. He did. He bought it, and then he's like, "Oh, nice run up in that stock." And his friend responded, "I don't even look at my phone unless it's a 15% daily move to the upside in the stock." It's like, that's where we're at.
Yeah.
Just straight up bars. But it can't go on forever. Or can
That's
it?
the thing. Well, I mean, eventually you do reach a point where valuations have gotten to a place, and this is right. This is not a quantitative measure. This is a qualitative, almost psychological state of being where people go, okay, I can look at the chart and see a lot of tail behind the chart, and we're in record highs, and it just feels expensive. I'm not going to chase this here. And then at the same time, it's like, well, do you have a great story? Do you have a great narrative? Is anybody not long yet? And of the people that aren't long, is there anybody that's looking at it and saying there's value, as opposed to, oh, look at this line, it's expensive? And so you just run out of buyers at the margin. And then the moment you get the first downtick, all of those that are already long go, oh no, this is what I've been waiting for this whole time. Time to cover. I mean, I think you kind of see that in futures positioning. If you look at the latest for the COT report, the Commitment of Traders report, and obviously it's quite a bit lagged, but nevertheless, as of Friday, we got numbers that reflected positioning up to the prior Tuesday. And what we see is that speculative net shorts in the S&P are at their highest since basically mid-March of 2024. Now, does that mean anything? Well, if nothing else, it suggests that people have been hedging, because short exposure has been growing since the bottom in April for S&P. So it feels like people are massively long the underlying stocks and then just attempting to lay off more and more risk in S&P futures because they see that as something that has to happen. They're not sort of piling the money into the risk on side willy-nilly and going, oh, well, this thing is just going to spin forever. They keep adding to net short on the index futures to cover. So at some point, one would think you get to a place where you just run out of buyers and the thing topples over. But where that is, and is there any indication of it here? Who knows?
Let's say it does happen. What level are you looking at? Like in the E-minis, for example, we're at 6,700.
Mm-hmm.
What if you're short? Where are you looking for this thing to go? 6,400? Below 64?
I think the next kind of line in the sand. If we're at the kind of initial line in the sand, let's call it like 66, 80, 90 on the December contract, ESZ for this year. The next line in the sand is maybe something like 65, 60, 65, 50. So basically that range that you carved out, let's call it the swing highs from mid-August and then into the second half of August. And then if you crack that, then maybe you're back down to like 6,300. And that's the base from mid-July. And then where we caught that NFP report on August 1st, that low, that's snagged right there. So that's maybe, those are your kind of lines in the sand.
Fair.
Something like that.
Yeah, I think it's...
But like, would I be an automatic buyer at any of those levels? No. If we're selling in that direction, I'm selling until it won't sell anymore.
Yeah, it's fair. But where do the buyers step in? I think it has more to do with the individual names that have a big contribution to this rally. Like, you see these kind of products. Like if Apple goes sub 200, there's going to be buyers. If Nvidia goes sub 100 again, there's going to be buyers. So like, that's a crazy move. It would be a crazy move, but yeah. I think there's psychological levels that people have in their mind that they'd be willing and able to get in there and try and stop it. But the VIX is still at 16. And what a nice narrative. E-minis end of the year implied volatility plus minus 370 points based on this current low implied volatility. That brings us to a shiny round number of 7,000. I can see it.
Yeah, maybe. It's interesting because if there were a story here to say, well, we're down over the past 2 days for this and this reason, then you could kind of benchmark it and go, well, they didn't like this. So that's going to tune my lens to say, okay, well, the next thing or the next kind of piece of news that we're going to get is going to be X. And on looking at the price action and on tuning the lens, then you can kind of do some scenario analysis and go, okay, if this, then that, if this, then that, across markets. You don't have that here. It just feels like things that have been going up for a while have stopped. And you struggle to find anything that's been going down for a while other than the dollar.
Yeah.
Maybe we're just revisiting a need for cash.
Yeah. I think we still have this issue of the velocity to the downside can be very real because there's such a concentration in these names in the E-minis. And if you look at ETFs, like it's hard to find a very balanced ETF these days. There's a handful, but if you see these single name equities that seem to rule the world kind of fall out of bed, that could create the selling pressure that we're talking about, which adds to the downside move, et cetera, et cetera, et cetera. It's just, like you said, a snowball effect. I think that's very real And we've seen it a couple of times already this year, but the opposite is true too. So I think it's got to be a scenario where if it happens, you got to be quick to act, still trading small and make sure risk is okay where you want it, but it could be a 1 or 2 week thing, if it does happen.
Yeah. Yeah. Dylan, if there is a sell-off here, are you looking for buying indexes or are there individual names on your shopping list?
I mean, I think that you want the Mag 7. I mean, it's the things that, like, if there's a real sell-off and you can get into some Google or some Microsoft or some Amazon or some Tesla, do it. I mean, I don't know how else to say it, but it's like, that's where the action is. It's if you're going to get a real honest to God sell-off, those are the names. I mean, I just don't see a world where the supernova or that level of momentum and that level of heat coming out of those names is going to go anywhere. And so if they get cheaper for some weird reason, I just don't know how much they're really, I feel like, I don't know how much they're going to sell off. I mean, I just feel like it's a tough racket for those guys to get. I mean, it's like, what's going to cause I guess it, like you said, the biggest risk, I think, is the one that you nailed, Ilya, which is they sell off for no reason.
Yeah.
Because the sell off for a reason doesn't exist. And so the only question is the sell off for no reason.
Yeah, I mean, it's kind of interesting. Like, if we haven't sold off for all the reasons that we've already seen, like, it's not like there's a shortage of reasons. There's no shortage of reasons, but we have so thoroughly ignored all reasons.
Exactly.
Good reasons, bad reasons. I mean, our motto here has been stop thinking, learn to love the bomb.
And so
that's what it is.
That seems like the only reason it will go down is for no reason.
Right.
If it's going up for no reason, if the reason it goes up is because it dismisses anything that you might think about that would cause it to not go up, then it might go down for no apparent reason.
And to
because it doesn't go down for reasons. Because I could list 1,000 reasons.
Yeah.
And they're all irrelevant.
And to your point, Dylan, I think I saw an interview with the great Zuck, and he was talking about how he doesn't care how much the spend takes to get ahead in the AI space. He said, like, if we overspend by 100 billion, it doesn't matter because that's how big the opportunity is, which speaks to your point of the Mag 7 stocks that are heavily involved in AI, heavily involved in, and the chip stocks too, heavily involved in that sort of world. We've seen the reaction in the market to the initial push for the AI wave, but if Zuck is still saying, I don't care how much I have to spend to get ahead, that's how big the opportunity is. Like, where does this thing really go? And maybe it's somewhere we can't even envision right now. But I think that was a really strong kind of tidbit of an interview where I was like, wow, if this is happening, this could be just the beginning.
I mean, obviously it's just the beginning, but like I said, I don't mean it like in a dismissive way, but it's like the only risk is just a blow off chaos. Yeah. But I don't see the risk. I'll be honest. Like, I can see where gold's going to come down. I can see where the dollar is going to get stronger. I could see where the Russell could sell off. I think these AI names are as bulletproof as anything. I mean, if you're going back to Xerox in the 1960s, man, like, this is money in the bank, baby.
Well, so you kind of wonder in the context of what Zuck said, like, and I'm not suggesting that Meta is equally a proven quantity than pets.com. Obviously, Meta has proven itself many, many times over. But how confident do you think pets.com was in basically saying this internet thing is the greatest thing? We're going to spend a gazillion dollars on an ad during the Super
Pets.com is
Bowl.
not Nvidia and Microsoft.
Right, right. But the hype around
the potential, the revolution
right,
hype is
that period's revolution. The sort of build out of networks, the internet is going to be everything for everyone all of the time. And obviously they weren't wrong. It just took longer and there was an intermission.
Mm-hmm. No, I mean, listen,
and it always takes longer, and there's always an intermission
on your part. Sorry.
No, I think we're in agreement. It always takes longer, and there's always an intermission. But finding where, it's tricky. It's sort of why I nibbled on the short side today, because for all I know, this could be it, and it's going to run down hard or not. Who knows?
Yeah,
but if the risk reward is good and the puts are cheap and the vol is low,
Yeah, Tesla's the only one that's really not like rolling over in this Mag 7 space here, at least in the last couple days. But yeah, I think I agree with Dylan. I think if we see a sell-off, the only thing that I would be concerned about if there is a sell-off is if the volatility curve changes in a dramatic way. If it doesn't, I think it is it's something that I will be placing bullish trades into the end of the year, especially with the way that the market is laid out now, where there's not many surprises priced into the next two rate cuts, which removes market volatility. And we've seen these earnings from these companies, and they are blowing out everything. So, and we'll have another one before the end of the year, probably in November for all these products. So it's a tough sell for a sell-off, I think.
It certainly seems like it. Mike, are you nibbling on the dollar here at all while everything else is kind of finding its way?
Yeah, so we have Glenn on from tastyfx every Wednesday, and we place currency pairs. So we were buying the dollar, we were placing long dollar positions in that platform. But yeah, I think long dollar, as far as it's gone, when you look at weighing any of these products against the dollar, I think it makes sense to nibble on some long dollar, especially in the tastyfx realm, where you can have a continuous rolling contract. You don't have to really do anything with it. You can just plant your flag in the sand.
You can just let it roll. Yeah, it rolls daily.
Yeah, it's beautiful. But yeah, I think
and you're long yield, so you're getting one of the beautiful things of being long dollars here. And obviously, it's baked into the futures. It's not like overnight financing costs go away in futures. They're just endogenized into the price. They're baked into the contract. But you're long yield against most of these other currencies. So interest rates are still, even after these cuts, higher in the U.S. than they are in Japan and Europe. And so you're getting paid to hold long dollar exposure. It's actually a yield-bearing idea.
Yep. Yeah, it is nice when you are directionally leaning a specific way, where the swap bid is a positive number for you, which is what we're talking about here. So in the tastyfx platform, regardless of what you're looking at, you can see the swap bids here and swap ask. So a positive number means if you are long this product, or I'm sorry, if you're short this product on the bid, you would get paid to be short. So what is being short the euro dollar? You are short the euro, long the dollar. So if you're short this pair, you're short the front currency, long the back currency. And if you did that in Euro USD, you would be getting paid a small amount, but you'd be getting paid to hold that position if that is your assumption anyways. So I've actually been doing that. Like I've been trying to find the pairs that speak to me where I want to be long or short while also getting paid to hold that position. It's like 50 cents or $1 a day. But if you hold the position for a month, that's $30 on a position that's like tiny. So
no, the carry trade that people talk about, that's exactly what this is. And I mean, in fairness, they do call it picking up pennies in front of a steamroller, but the steamroller in the dollar has probably already passed. I mean, we had the worst 6 months basically in the modern era for the dollar at the start of this year. I mean, essentially since Nixon took the dollar off the gold standard. So one might think now you're picking up pennies after the steamroller has already rolled.
Yeah.
So, hey-o.
And honestly, like the really nice thing about this is that when these markets are like this, where it's just a grind, it's like paint drying, you can find really cool opportunities in here. Popular USD, non-USD, other non-USD, Scandinavian, emerging USD. Like literally there's 100 pairs in here that you can dive into if you want to.
Yeah. And I mean, obviously, be mindful of liquidity with this as you are with anything else. I mean, when you get into the EM currencies, the spreads are going to be wider, the liquidity is going to be choppier, but compare that to Bitcoin versus S&P. I mean, Bitcoin is going to be risk appetite, but jumpy and with wider spreads, as opposed to the S&P. The euro is going to have narrow spreads and good liquidity, and some of these emerging market currencies are not. So approach accordingly.
Indeed.
With that, I think overtime is out of time. Any parting thoughts here, gentlemen, while we have a minute?
And I'm just going to reiterate, if you do get any selling in those AI names, I would just buy. I wouldn't even, like, if you're going to be short, get short gold, get short the Russell. I wouldn't mess around with the AI names. And if you're lucky enough to get them cheaper, buy them, don't sell them.
Yeah, I mean, I would echo the same thing. I think the volatility structure is telling us that we shouldn't expect anything crazy. So if we do get a small pullback, and that is also paired with a non-movement or a relative non-movement in volatility futures, then I would be totally in Dylan's camp. I think the only thing that might shift my mind there is if we get a larger sell-off consecutive days and a large shift in the volatility structure, then I think that could be a sign for future bigger moves to the upside and downside, but leaning towards the downside.
Yeah. I mean, I'm not sort of foaming at the jowls bearish here. I have a little bit on just on risk reward grounds, but otherwise I'm long dollars, and that's really my core exposure. And I'm a little bit long the bonds just because they seem to have found some kind of a bottoming on their pullback, and that's really it.
Cool.
All right, gentlemen, thank you very much. That's it for overtime. Don't go anywhere. I'll be right back with Macro Money, where we'll unpick the data that has just passed us by over the past 24 hours. There was some PMIs. Powell spoke. We'll see what that all meant in excruciating detail, and then look ahead. So stay right there. We'll be right back.
When the market moves, traders need to move faster. tastytrade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, tastytrade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on tastytrade.
If you've ever been curious about where to start with crypto, join me, Ryan Grace, for the Tasty Crypto Show. Alongside co-hosts and industry guests, we'll break down what's going on in the market and show you how to take advantage of crypto. No hype, no shills, just crypto know-how. Watch us live, join the chat, and fill your bag each week on the Tasty Crypto Show.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
When you define risk, you set a limit on how much you could lose if the trade goes bad. If you have a small account, you might not be so interested in selling naked options. You'd use up much more buying power, and the risk is undefined. Defining risk, though, controls how much you can lose if the trade goes sour, and it gives you back some of that sweet, sweet buying power. We can define risk by combining options into certain strategies. The short put vertical spread is the simplest one. Selling this put sets your max profit with the credit, and the long put at the lower strike blocks off the risk where you want it. And if you're more neutral than this, you can throw on a vertical call spread to make it an iron condor. The only downside to defining a risk is that it lowers both your max profit and your probability of profit. That little compromise might mean you rest easier, though, and a good night's sleep is priceless. So see, we can define risk when we use more than one option at a time. Pretty simple.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
If you had to swap jobs with somebody else in this office, who would you pick and why?
Oh, if I had to swap jobs, I kind of like the idea. I might go for Tori's job because I really want to be the one responsible for ordering lunch. I would love that responsibility.
Maybe somebody on the other side, on the brokerage side. I'd probably swap jobs. You know, I'd probably swap jobs with Clink. Clink has a lot of cool looking tools that he looks at day to day, a lot of that risk management stuff. It's kind of interesting to me. I'd probably be honest.
Oh, I got to go Scott. I mean, he's only here a couple months, goes back to, Arizona, plays some golf, Tokyo. I mean, that's a great gig. Why? How do I get that one?
Oh, I think Ryan Sullivan's got a great job, man behind the camera. He does a lot of cool stuff all around the office, from videography to written content, so he's the man.
Ryan, would you want Glenn's job?
Absolutely.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Stock markets come down for a second consecutive day. Does that mean anything? That's what we're going to explore here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And it's been an interesting sort of week in the wake of last week's Fed policy announcement. Markets seemingly trying to find their way, and looking across assets, things kind of sliding in new and interesting directions, seemingly without any kind of rhyme or reason across markets. It's very difficult to thread a macro narrative here with what's going on, but we are certainly going to try. And that's where we'll start things off. We'll just look at how markets were performing today, what we have so far this week, how that lines up with where we were last week, and a little bit on the macro news flow that we've already seen this week, because it has been significant and it has been telling us a story. So, looking at first the S&P and NASDAQ here, of course, just for today, off about 1/3% apiece. And interestingly, yields higher. So there is perhaps some semblance of rhyme and reason here starting to develop. So the longer end of the curve a little bit stronger, 10-year up 1%, 2-year up 0.5%. Crude oil still doing its own thing, not really paying attention to what's going on elsewhere and oscillating in familiar territory. There's about a 54 to 74 range in crude that has held for months and months and months. And now we're kind of looking at prices testing the upper part of that range, but not really going anywhere beyond it. The center line for that range, right around 62, and the internals of that range around 65. So markets have been essentially oscillating between about the low at 60, 80, 61, and up to as high as 65, basically going back to early August. Haven't really gone anywhere, but broader terms, this center line around 62 has been in place at least since early April, and we've kind of oscillated around that with lows in April, of course, as we have for most risky assets, around 54, highs around 73, 50, 74 in late June, and then just oscillating in that space without really finding a clear connection with the broader narrative. Gold, however, with a spirited sell-off today, down 1.25%. Dollar also uniformly stronger across the board, up 0.6% against the euro, almost 9/10 rather, almost a full percentage point, in fact, against the yen. Bitcoin, interestingly, higher, 2.4%, but that's not really telling us a story about sort of overall strength, because, of course, Bitcoin has been down for 3 days into this little bounce and is just kind of retesting a little bit, but doesn't look like it's really putting on a convincing reversal of those earlier losses. And indeed, if we look at how the markets have performed cumulatively so far this week, stocks down, but about 0.4%, a little bit less on the S&P, about 0.5% on NASDAQ, yields up. So that part of the story seems to be holding. Gold still net up on the week, although, of course, much more narrowly so after today's sell-off. Dollar up, although, again, more narrowly than just today. Euro down, yen down. Bitcoin, on the whole, still down for the week. So if we compare here, while gold is down today but up on the week, Bitcoin is up today but down on the week. So a little bit of jostling there. But on the whole, what we seem to see here is perhaps a little bit of a hangover after last week's Fed policy announcement. The Fed, as we've discussed here before, came out less dovish than expected, or at least than the markets wanted. And we can see that in this summary of economic projections. As we've noted before, we have expectations for GDP upgraded across the forecast, expectations for the unemployment rate downgraded, inflation adjusted higher, at least for next year. And when we look at these policy expectations, we can see that now the Fed in September had 3 rate cuts narrowly on the menu, as opposed to 2. The starting line was 4.4. So June's projection was down to 3.9. That's 50 basis points. This projection in September was down to 3.6. That's 3 cuts. That largely already existed as a forecast in the markets. So we were looking at the likelihood that we'd have a October rate cut already very much on the menu when the Fed came out. And of course, now it's very strong indeed at about 91, almost 92%. But even a week ago, going into the Fed, we were looking at 87%. So it's not like there's been a violent shift here. The markets knew that this October cut was probably going to happen. And then in December's meeting forecast, now we're looking at a 75% chance that we're going to get that third cut. A week ago, it was a little bit stronger even at 81%, and that's going into the Fed meeting. So it's not like the markets didn't know. It's not like the markets weren't already priced for 3 cuts this year. They already had those probabilities very firmly established. So the Fed didn't really tell them anything that wasn't already in the market. But if we look at what then happens thereafter, still only 1 rate cut on the menu for next year and the year after. And of course, as we've said, this continues to be a potent disconnect with markets, even though they've started to kind of go the Fed's way here a little bit. Markets still see 63 basis points in rate cuts next year. That's obviously at least 50 and 13 basis points in the direction of a third cut. And if we do the math here and what this ends up looking like, it's a 52% chance that we get that third cut next year. So we're kind of hovering at the dividing line. The likelihood of that third cut next year has come down a little bit, but nevertheless, it's not 1 cut. It's well in excess of that. And so as we look at what's going on here, we can see this year has anchored nicely around 35 basis points, so that's at least 1 cut, and then showing us the likelihood of the third one. And for next year, there's still this disparity. Nevertheless, the markets are starting to claw back some of this easing. We can see we're narrowly down to about 100 basis points, just under, in rate cuts cumulatively, whereas going into the Fed before this 25 basis point adjustment right here, we had 140 basis points on the menu. So take that 140, subtract from it the 25 basis points that we just got, and what you end up with is 115 basis points, whereas the market is now at 98. So there's a little bit more here than just taking away a rate cut that's already occurred. Now we're looking at maybe the markets are starting to embrace this idea that the Fed wants to run the economy hot and address the weakness in the labor market that it perceives that way. And one of the more interesting kind of ways to read this, of course, comes once again from Fed Chair Powell. He spoke just earlier this week. The comments, not exactly anything that you might not have anticipated, having heard what he said at the FOMC announcement itself. But what we see here is interesting in the sense that it really distills the Fed's argument here, saying, look, there's no risk-free path. We're not ignoring that inflation is there and rising, and as of the last CPI numbers hit a 70 or a 7-month high. So the Fed is very clearly acknowledging here that, look, it's not like we're saying that inflation is solved and that's why we're cutting rates. We're saying the risks to the labor market have increased, and so the balance between the trade-off of containing inflation and underpinning the labor market, that balance has shifted. And that's what has prompted this cut. We can see also that on the inflation front, Powell is making the argument that goods price increases largely reflect tariffs as opposed to something more entrenched, and that it's a reasonable base case that this tariff-driven inflation will be short-lived once the one-off price adjustment is basically absorbed into year-on-year calculations and rebased. In the Q&A after this speech, we can see that the Fed wants to focus on a more balanced approach as opposed to just inflation. A couple interesting tidbits here is that we see the Fed saying maybe what's happening in the labor market is part of how businesses are dealing with the tariffs, because of course we see that the tariff pass through, according to the Fed chair, has come later and has been less than expected, and that is something we've talked about here quite a bit. This idea that wholesalers were eating tariff costs on behalf of consumers because they didn't want to destroy demand by raising prices, but that this process has arguably ended at this point. That now we're getting that pass through, and wholesalers' margins have started to expand again, as we saw most recently in the PPI data for September. So as we look at this, then, we get to a place where the Fed's argument is, okay, we've had businesses shoulder these tariffs. Maybe they're not hiring because that's where the firepower has gone. The spend has gone toward managing these tariffs, and that's why businesses don't want to be expanding staffing. Nevertheless, the Fed thinks this is going to be a one-off pass through, to some extent, famous last words. We'll see how this goes. But one argument going in the Fed's favor here in kind of focusing on the labor market and considering inflation something that they can not de-emphasize, but balance a little bit less heavily against needing to work to underpin the labor market was the S&P Global PMI report this week. We can see the composite index showing us we still have growth, of course, as ever. PMIs are centered around a 50 line, where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So you do have growth here, obviously. Here is the 50 line down here, and this was the latest reading. So we're well above 50. The economy is growing. But we can see here that over the course of July, August, and September, the pace of economic activity has slowed. And it's not just on one side or the other, it's both. So here's manufacturing. This is where, of course, tariffs are most acutely felt. We can see that there is a pullback here and a slowdown there, albeit a more modest one than what we see in services, where there is this thing echoing the composite index and a third month of slowdown there. So maybe the economy is, in fact, starting to come down a little bit. this data, of course, was early to speak about the reflation from an economy that was reheating as early as May. So we can see that we got this buoyancy here that we didn't really get in a lot of other measures. This is why this S&P data is so good. It's quite early, usually. We got this for the composite index. Now maybe we're starting to come off a little bit. Maybe this is speaking to the Fed's sort of relatively benign view of where inflation is heading, and perhaps even to some extent endorsing what the markets are suggesting, because one of the more interesting parts of this is that with slowing activity, you've also seen a little bit of a downtick on the price front, but for inputs into services. So you can see here, especially where the tariffs are the most acutely seen on the manufacturing side, costs have edged lower. And you can see that as far as output prices go, they've edged lower for both services and for manufacturing. So if you look at the composite here, we can see overall the price structure is getting less inflationary here. Again, we're still very much in positive territory, so we're well above 50 on the overall index for composite prices, but clearly the pace of inflation has slowed here. So maybe that's helping to endorse what the Fed has done here. Now, where this gets interesting is, of course, when we start looking at the relationship between what's going on with the policy outlook, since this has been the driver of momentum recently, and we see what stocks are doing. Here is this sort of baby pullback this week. That's this right here. But we can see that there's not really a strong level of consistency. So whereas at the beginning of the year, it was clear, sort of here is the near-term range. Here is where we broke that range. You can see here at the same time is where you get the start of a dovish move in policy expectations. Then, of course, in early April, that move finds a bottom. And it makes sense that these policy expectations move at the same time as stocks do, because this ends up being a growth scare. It ends up being a conversation about, oh, well, the rollout of these tariffs is going to hurt growth. Business and consumer confidence are down. And indeed, the PMIs were some of the earlier indicators. And then, of course, we rebounded once sentiment steadied, and it looked like the White House was going to be amenable to market discipline of this variety, where stocks go down and bonds go down and the dollar goes down all at the same time. And so sentiment starts to recover, but notice where the policy outlook actually lands. Stocks ultimately rebound and the growth scare fades as you get this rebound in the policy outlook, but it stops well short of what happens with stocks. Stocks come back basically to where the breakout was right here. That's where the end of the unwind of dovish expectations is in Fed funds futures. From there, things only get more dovish. So even as this year's outlook anchors around sort of a center line of 50 basis points and cuts, sort of right around here, the outlook for next year starts to get more and more dovish. And the rest of this build out in stocks seems to come at the same time as you get the promise of cheap money getting louder and louder and louder. Then you get this move. And at first we can see stocks are happy. Even though we have this larger than just a 25 basis point adjustment and things get a little bit less dovish, stocks still find a way to love this. And we've posited that that's because they're betting that the Fed's going to run the economy hot. But now perhaps things are getting a little bit soggy. So maybe we've reached a level where the money is now getting uncomfortably less cheap. We're going to have to see how this goes because, of course, this is just a blip on the radar so far. For the dollar, though, this does make a lot more sense. The dollar seems to find a bottom here where it last tested in lower in early July, and as things get less dovish, so too the dollar seems to be finding impetus for some kind of a low setting. This seems to be working as you might expect. When things get more dovish, the dollar falls. When things stop getting more dovish, the dollar starts to bottom. So fairly straightforward here. Now, as far as exposure goes, I'm still looking for that dollar rebound to continue, so I'm still short the Aussie, short the pound, short the euro, short the Canadian dollar. I've taken off my gold long position, which I held for the better part of 2 months. It seemed to have hit some kind of a roadblock today, and that was coming up on expiration, so why not take some profits? And I'm still long silver because this actually did not have a meaningful move down today. It's a little bit soggier here, we can see, but it hasn't really taken out its digestion range, and so I'm still long the precious metals there. I've started to nibble a little bit on the short side of the S&P through a put vertical on SPY here. Certainly not looking for any kind of Armageddon-like scenario, but after 2 days of selling, it does seem like while the vol is cheap, in the event that this is the real deal, then maybe take a little stab here with better than 2-to-1 risk reward, and still a little bit long the bonds, looking for this to bounce a little bit. It started to go in this direction a little bit, and so this is maybe the beginning of something, but we'll have to wait and find out. It's still early days yet. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise writing for the News and Insights portion of Tasty Live and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. In the meantime, happy trading.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100 shares of long or short stock.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
If you missed the live show, here's our cherry on top weekly recap.
You became Chicago's most eligible bachelor. What year was that? That was the debate we were having earlier while you weren't on the show to defend yourself.
1988.
88. So Vanetta was right. Late 80s, early 90s.
You mean when I was on the Oprah show?
Yeah.
Yeah. Well, 88. I had flowing locks like Tom.
Oprah just made it.
Oh, here it comes.
I mean,
she felt bad. She felt badly for him. You know, you couldn't get a date.
You get a car, you get a car, you get a Scott Sheridan, you get a Scott Sheridan.
I want the car.
That's right.
I think I went down the typical path of investing in stocks, and I was really frustrated in the sense that it was a buy and hope type strategy. And so I was looking at, different ways to learn about options. And I saw Mike and his whiteboard, and it all made sense. There's another world out there with options. It gives flexibility. It's more capital efficient. And tastylive does it again. They teach it in a way that is fun. It's easy to understand, and you're learning from people that have done it for 40 years.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
When you've got a futures contract that's in contango, what does that mean?
Futures, unlike stocks, have multiple prices appropriated to them. That's known as the forward curve. So when a futures forward curve is in contango, that means that the front month is trading cheaper than the corresponding futures back month. So you'd see that forward curve most likely looking like this in terms of prices.
And backwardation, what does that mean for futures contracts?
Backwardation is the opposite of contango. So where contango front month futures contracts are trading cheaper than the back months, backwardation is the opposite. So those front month futures contracts are trading richer than the corresponding back month contracts.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
All right, we're back. Tasty Crypto Show. I'm Dan Cecilia, and today in studio we got a very special guest, Greg Magadini, professional options trader and head of derivatives at Amber Data. He's a regular on the show, and always great to have you and share the insights. So thanks for joining us in studio. How's it going?
Yeah, thanks so much, Dan. I mean, the studio is pretty nice. I can't lie. This is amazing. So happy to be here in Chicago. Fun experience. Happy to talk to you. Got plenty of stuff to talk about. So let's dig into it.
Yeah, for sure. And I I appreciate the kind words about the studio. I think it's the coolest part of the entire thing. So most of our guests, when they come in, they're like, "Yeah, studio's sick." So you're totally right. But you know, we follow your newsletter a lot. Whenever we have you on, we kind of go through and kind of just break down your thoughts. So let's just jump into it from last week. We had this Fed update and like an interesting market reaction because it was the cuts were priced in, but market reacted strangely. So can you just kind of give us an overview of what happened there?
Yeah, so just to contextualize where we are. So last year we cut 50 basis points. Inflation was actually lower last year than it is now when we're cutting. So that's kind of an interesting context, but just to kind of talk through the market reaction. So risk assets really rallied into sort of this FOMC rate decision. And really how the way I interpret that is that the market was pricing in cuts and future cuts. And so the initial reaction when the Fed cut 25 basis points was really around the guidance that we saw in the economic projections of 2 more cuts throughout the end of the year. So we can see the dot plot here on the screen. And so that was initially bullish because not only do you get the cut, but they're kind of hinting that they're going to cut twice more. And then later in Powell's speech, he mentioned that a 50 basis point cut last week was completely off the table. So then that flipped from dovish to hawkish. So risk assets kind of had one of those big spike days. And then to top it off, Fed Powell essentially said, you know, he has no idea where inflation will be in 3 years. So he's been data dependent, really slow to move this whole time, really wants to see how job numbers come in, how inflation data comes in. So we kind of got more of the same. That's how I interpret it. And so I think a lot of traders had to like adjust their positioning throughout the day. And we got sort of this kind of big spike candle reaction.
Gotcha. Yeah. So if we look at the dot plot here, and then even this Fed watch tool, you got an 80% probability for target rate of 350 to 375 bips. You said that Powell's speech noted 50 basis point cut was completely taken off the table, so struck the markets as hawkish. We sort of had a sell-off in Bitcoin, I guess, or risk assets, sort of a little bit of a sell-off, and then gold reacted, right? So there's been this divergence that we've been following between gold and Bitcoin. Do you think that Fed rate decision kind of made that gold rally, and sort of what do you make of that divergence between gold and Bitcoin?
Yeah, so I think gold is the classic fiat hedge. So I mean, gold is the money of 2,000 years plus, or whatever, 5,000 years, whatever the number is. Gold's tried and true, and we know that central banks buy gold and essentially have gold reserves. We know that the U.S. dollar has been world reserve currency. Everyone owns U.S. treasuries, but if you are in this inflationary environment, do you really want to hold treasury paper? And if you don't want to hold treasury paper, what other paper are you going to hold? I mean, if we look at the rest of the world, most of the Western world actually has lower rates and has inflation as well. So that's a lot less attractive than U.S. paper. So you're kind of stuck buying gold. And, as we know, crypto to some people still seems kind of like, a gambling asset or like an asset that hasn't been untested and unproved. I kind of think the U.S. is leading the way in that narrative shift. So I think probably the first one to buy Bitcoin reserves would be kind of a U.S. country. So I think that's what's happening. Right now, central banks and traditional players are buying gold as a dollar hedge.
Yeah. And I want to talk a little bit about the point you make about the Fed here. You think that you kind of get into this idea that Fed's a bit worried about jobs versus inflation. They're going to monitor both.
Yep.
But you think that the biggest driver of asset prices, particularly gold and Bitcoin, is Fed's independence. So, we have a new chair in 2026. Do you have any comments on that? Like, do you think Fed's independence is in question, and maybe that gives us a rise in risk assets, or?
I think that's the biggest risk for sort of asset inflation.
Okay.
So, the way we see it right now, there's a lot of pressure on Powell to hurry up and cut rates. He's like being cautious, still data dependent. He says, I've tilted towards jobs being my number one concern, but, we still trust him to care about inflation. Well, if inflation starts running hot, we got PCE this Friday, which is the inflation target number. That's what the Fed looks at, core PCE. If that comes in hot for whatever reason, and we know next year that Chairman Powell is going to be replaced, does the market really have the confidence that the Fed is going to be willing to fight inflation like it has been? I think the market's saying no. That's kind of how I'm interpreting this. And so what do you go into in terms of inflation hedging? And so I think that's why we're seeing this kind of gold rally. I think that is the biggest right tail risk.
Gotcha. Okay. And so we'll have to look to Friday to see how that PCA data comes out. Now, just so I have it correct, you think with this the Fed independence in question, maybe what happens in 2026 with the Fed chair, you think it will give a boost to risk assets if we do kind of get this, I guess, Fed independence, basically the Fed is not independent anymore and won't do what needs to do to kind of support the dual mandate? Or you think it will give a rise to Bitcoin assets, risk assets?
I think if there's essentially a stagflationary environment or a runaway inflationary environment, 1970s is what I would look at as the sort of the template. And that was an environment when gold went from $35 to $700 in 10 years. So I think that's sort of the base case scenario I'm looking at. Now, in terms of Fed independence, where am I looking at for sort of that trigger? Long-term treasury debt. Long-term yields, in my mind, are kind of the story to tell. We're seeing this in Japan right now. So Japan 30-year yields are spiking in a fashion that they haven't in decades. And to me, it's like, let's not forget, Japan invented QE. Japan had its own real estate bubble. They're like 20 years ahead of us. So theirs was in 86, ours in 2008. And they're the ones who essentially invented QE and squished down rates to zero. And we're stuck in this deflationary environment and have the highest debt to GDP ratio. So they're sort of the canary in the gold mine of the quote-unquote debt supercycle. That's how I view it in my mental model. So they're the country that I look to the most. And then for the U.S., long-term rates are sort of what I'm monitoring in terms of Fed independence coming into question.
Gotcha. Okay. Interesting. So something we'll have to take a look at and keep in mind. I think, like you said, Japan is kind of the leading indicator there. I think bond yields did bond yields spike? The long end of the bond yields did spike after this cut.
Yeah, exactly. Yeah. They also had one of those like kind of wick hours. Yeah. But then now, bonds are cheaper, yields are higher.
Gotcha. Okay. So maybe some signal there that, could something be on the horizon. So let's get into some trades.
Yeah.
Because this is, I think, was the most interesting part of the newsletter was how you would position yourself here. So the trade that we've been covering and you've been saying looks sort of interesting is this 180-day 25 delta risk reversal.
Yes.
Can you get into that a little bit and just, what's your reasoning for that?
Yeah, so there's kind of two things I'm looking at in crypto vol. So the first thing is outright at the money vol for Bitcoin. So this is this first chart I'm looking at right now. 180 days is looking like 41 vol. We've been as high as 120 vol on 180 days. 41 vol is kind of the lowest we've seen in the past 6 years. Now, something I like to keep in mind is that when vol is low, everyone expects it to mean revert. So it usually trades at a premium to realized. So vol can remain lower, as I said, and you can remain solvent, so to speak. So just buying outright vol is never the most interesting thing to me. And that's where the risk reversal comes in. Because with the risk reversal, you're selling a put, a 25 delta put, in order to buy a 25 delta call. So now you're kind of vol neutral. And if things really kind of explode higher, which is sort of that right tail Fed independence trade, well, not only do you own the call that's giving you the delta exposure, but now you're going to be in a situation where vol is exploding higher as you own the right tail. And so that's kind of a double winner on that sense. And then you finance that by selling that put. So a 25 delta put is kind of like, I don't know, $56 on IBIT, which translates to about $100,000 Bitcoin price. So you're essentially standing on the line and saying, I'm willing to buy $100,000 Bitcoin. In exchange for that, I'm going to get the premium that I'm going to buy the 25 delta call. And so now you kind of have this big break-even window Worst case scenario, you buy $100,000 Bitcoin. For a lot of people, I think that is an attractive level. And then on the flip side, if things go haywire to the upside, you have that exposure captured. And looking at that risk reversal chart here, we can see this is the first time in quite a few years that we're below the zero line, meaning the put is more expensive than the call. I think there's a few reasons for that, and we can get into that. But it's rarely here, for the exception of sort of the FTX blow-up time frame.
Right. Okay, so let's kick it over to the platform real quick, because I do want to demonstrate kind of how we can construct this trade using IBIT. So I'm looking at IBIT. Obviously, the market's closed. We could do I think we can do an extended hour order, but just do it. We'll do a demo for now. But basically, we're looking at the IBIT ETF. We're going to go out to the March 20th, 2026 expiration, 180 days. And we're going to look to buy the 80 strike, 80 or 85, because the 80 is the 32 delta, 85 is 26. So I guess we could buy the 85.
Yeah, I mean, it comes down. If you want to pony up a couple more bucks for the closer one, it ends up.
It might be better.
It might be better. Yeah.
All right, so let's buy the 80, and then let's go and finance that with the 50 delta, the 54 delta, 54 strike, 24 delta put. So we're going to sell that. And on the platform here, we're looking at, it's about $5,500 to get into that position. We're looking at a 57 debit right now.
Yep. So you can play with those strikes a little bit if you want sort of to get away from the debit. If you're willing to pay the $50, you get, slightly better strike on the call side, slightly lower strike on the put side. You can kind of tweak that. It's not really going to change the nature of the trade.
Right.
And to your point, the fully cash secured is the 50, call it 5,400 plus the 57.
Right. So, and really what we're looking at here is playing for that upside, playing for that Fed independence trade. So your max profit is, there's all upside there.
Yep.
And your max loss would be and essentially the credit, the debit you're paying. Is that it? Or the position?
You'll assume the position if we go below that 54.
Yeah.
But if you're willing to buy Bitcoin at 100,000, that's kind of a win as well.
Right. So it's kind of like a synthetic limit order, and
yes.
And that 100,000 strike is pretty attractive, or the 100,000 price is pretty attractive if you're bullish Bitcoin long term. You get it at a discount essentially, and then if it does spike to the upside, it's all profit there, right? So.
Yeah, exactly. And this is so like the way that we're structuring this trade, we're kind of like talking about it in like a long-term portfolio position. If you were really just truly trading it for vol, typically you would put this trade on with leverage and you wouldn't do cash secured and stuff like that. And what you'd be really looking at is, the spot vol correlation of Bitcoin. If the spot vol correlation of Bitcoin flips back towards a positive spot vol, so meaning when we rally with more volatility than when we sell off, that vol surface structure that we're seeing now would benefit a lot. And so that's historically how it's been. Lately, since IBIT launched options, we've kind of seen a consistent decline in that. And the reason why I think that is we have asset managers who buy equities. They typically sell covered calls, buy the put, which is the opposite of what we're doing.
Right.
As a risk asset hedge. And I think it's kind of the same investor base. We also got to keep in mind that Bitcoin doesn't pay a dividend. So the only way you get yield from it, if you're a long-term investor, sort of traditional investor, is by selling calls against it. So that's causing the call wing to flatten. And then we also have like covered call ETF strategies that are accumulating assets under management. So these are the people on the other side of our trade. And so it's important to kind of understand why is it priced this way, to understand if it's really a good trade or if you're just kind of stepping in front of the train, so to speak.
Right. Okay. Yeah, it's a great point. Something that I think a lot of retail traders, especially myself, because I'm, I would consider myself like a smaller retail trader, don't necessarily understand like why it vol, like why is vol like this? What is going on? What is the market structure for Bitcoin? And to your point, you lay it out great in the newsletter. It's these institutional investors are hedging. Mm-hmm. So they're selling the covered call and buying the put, the opposite of what we're doing here. Bitcoin's non-yielding, similar to gold. So covered calls is a source of income. And then the ETFs, right? The growing AUM of the ETFs is sort of volatility dampening, in your opinion, right?
100%.
Okay.
Yes.
Yeah.
Yes. And those are the flows that we've been seeing. And to come back to gold real quick, because I do think gold's such an interesting barometer.
Yeah. Let's take a look at gold. Yeah.
Yeah. So when we look at the vol surface of gold, gold has a positive risk reversal. So the 25 delta call has a higher vol than a 25 delta put. So that's inverse to what we're seeing in Bitcoin. So that's divergence. Bitcoin is being priced as a risk-on asset from the vol surface perspective. Gold is being priced as sort of fiat hedge. But I don't think the whole story is Bitcoin is a risk asset. I do think Bitcoin is still a new kind of fiat hedge. And so I think gold's rally is a good sort of prelude to what we can see in Bitcoin.
Right. Okay. Yeah. And, we're looking at the chart here, GLD, which is the ETF. I mean, look at that candle. It got up to 350. Got up to 350, on the month. And if we take a look at, and I just want to dig into gold a little bit because I do think it's interesting. If we take a look at the options chain, you think that is there a trade here? Same kind of risk reversal trade you're saying, or?
Yeah, I don't think it's necessarily a trade I want to put on, but it's a trade to look at in terms of like comparing the pricing to Bitcoin.
Okay. Yeah. So is it the same type of thing? The 25
delta, 180 days out, so same kind of expiration.
Okay.
And what you'll notice is that the call trades at a higher vol than the put. And the way that you want to calculate this is you want to go call implied volatility minus put implied volatility divided by at the money volatility. So you can normalize, because gold has about half the vol as Bitcoin. So you want to normalize how big is the differential in at the money terms.
Gotcha. And kind of the overarching sort of idea here is you're looking at the pricing.
Yes.
Between the two, because you think that they'll trade similar, right? Gold is the fiat hedge that people accept now. Bitcoin will be there. So it's kind of, you think it will catch up, or that's kind of what we're implying, is that it might catch up to be a fiat hedge. So there might, we're looking at the pricing essentially between the two trades. Okay.
Yep, that's what I think. I think, there's a good argument to be made. We were talking about this before the show, highly portable assets have a lot of value in sort of uncertain times.
Right.
And crypto is perfectly portable. I mean, you don't even need a hardware wallet. You can just remember 12 words in your head.
Right.
And go wherever you want.
Right.
I think if there's true sort of fiat panic, we'll see both gold and sort of Bitcoin hockey stick. But let's keep in mind that Bitcoin is 1/10 the market cap of gold, takes less money to move it around. So in my mind, those risk reversals should trade in similar fashion.
Gotcha. Okay. Yeah. I think it's an interesting note. I'm going to definitely, after the show, maybe tomorrow morning when the market opens, take a look at that IBIT one, because I got to admit, I've been following the trades and they've worked out well. I did the MicroStrategy one, selling the call spread, financing some of the ETH upside. I need, we got a couple minutes left. I wanted to get through this risk reversal idea and kind of show everyone what we were looking at here. Anything else in your mind? It could be anything. Is there any trade, anything you're looking at? Doesn't even need to be crypto, just anything. ETH could be Sol. What do you, anything here?
Yeah, I think another theme that probably will keep coming up, as we keep chatting, I think the digital asset treasuries are going to be an interesting theme going forward. I read this book about the 1929 crash a few years back, and for anyone who hasn't read about the 1929 crash, in a 2-second version, people were buying stocks were doing well. People set up holding companies that would issue shares to buy stocks. So then you buy the holding company, kind of like an ETF to own portfolio. Then holding companies started borrowing debt to buy more stocks, and you get leveraged holding companies. And then you got holding companies of holding companies, and then you got leveraged holding companies of holding companies. And if we look at the digital asset treasuries, we're kind of seeing that same type of play. First, you take the cash on your balance sheet and you put it in crypto. It's non-leverage. Then you raise debt to buy crypto. And at some point, we'll have ETFs of holding companies, and then we'll have leveraged ETFs of leveraged holding companies, so on and so forth. I think that's going to be a very interesting sector to pay attention to, especially as holding companies try to catch up and go further down sort of the risk asset tokens.
Yeah.
So it's one thing to own Bitcoin. It's another thing to own Ethereum. Then you start owning some random coin with small float. Then you leverage that random coin with small float, and any sort of pullback cascades. So that'll be an interesting theme to look at. Keep in mind.
Yeah, I think that's a great point. I've been doing this for our weekly newsletter. I put together a watch list of all the crypto treasury companies I could find, and I'm including like Coinbase and Circle in there, just in Galaxy and even like Backed and so just basically any type of crypto public company that has crypto on the balance sheet. So one that came up recently, obviously we've done MicroStrategy, covered that a bit. One that came up recently is this Forward Industries, which is the Solana one. So to your point, we're getting farther out in the risk curve here, because as a crypto native, we're looking at Solana and we're like, this is a great chain.
Right.
I'll hold the spot product.
Totally.
I don't need exposure through an ET or a crypto treasury company, but maybe some people want to trade that. So this Forward Industries is one. We obviously had Tom Lee's BitMine, which was the big trend in July with ETH running. And now I've heard we're getting we're getting even further out. So there's a couple for some yield-bearing stablecoin one. I think they've talked about Hyperliquid, which is like a perpetual future exchange token. I wrote about it in our newsletter. So we're getting there, to your point. And I think like what people don't necessarily understand is the way that these things can be structured, right? It's like raise money and go buy the spot asset, fine. But eventually they're going to start borrowing because maybe the price goes up or the NAV goes up and they can borrow against it, and kind of becomes this debt bubble essentially, and it'll unwind at some point is kind of the point you're trying to make. So don't get too far out on the risk curve. Basically.
Yeah, and careful with leverage. We saw huge liquidations this week.
Yeah.
And the market barely moved. So let's keep that in mind.
Yeah, exactly. Yep. So, all right. Well, love having you on. I think it's always great to talk about some of this stuff. We'll keep monitoring all of this. And, anything else around, like, where can people follow you and so maybe subscribe to the newsletter?
Yeah, absolutely. So you can check out our newsletter at amberDataDerivatives.substack.com. And you can check out our free platform where you can look at all the volatility profiles for crypto vol, including perpetuals and futures, the basis, leverage, open interest, liquidations, all that good stuff. pro.amberDataDerivatives.io.
Great. Well, that's all we have for today. I'm Dan with Greg in the studio. We'll see you next time. Peace.